October 19th, 1987, 9:30 a.m. The opening bell rings on Wall Street. Within minutes, something unprecedented begins to happen. Computer screens across America start displaying numbers, falling numbers, red numbers, numbers that shouldn't be possible. By the end of this single day, the stock market will lose 22.6% of its value. Nearly $1 trillion will vanish. Fortunes built over decades will evaporate in hours. But here's what almost nobody talks about. This wasn't just a market crash. This was the first time in human history that machines triggered a global financial catastrophe. And the scariest part? We almost didn't survive it. To understand what happened that October morning, we need to go back to a time when America felt invincible. The mid-1980s, Reagan's in the White House, the Cold War is winding down, greed, according to Gordon Gekko, is good, and Wall Street? Wall Street is booming. From 1982 to 1987, the Dow Jones Industrial Average triples. Everyone's getting rich. Your neighbor's getting rich. Your dentist is giving you stock tips. But something else is happening. Something quiet. Something that will change everything. Computers are taking over Wall Street. Now, these aren't the sleek machines you're watching this on. These are massive, clunky boxes with screens that glow green and orange. But Wall Street sees potential because computers can do something humans can't. They can trade at the speed of light. Enter program trading, the newest innovation. Here's how it worked. You write a computer program that automatically buys and sells stocks based on mathematical formulas. When stocks hit a certain price, the computer buys. When they drop below a threshold, the computer sells. No emotion, no hesitation, just pure, cold mathematics. The old guard, the traders shouting on phones, sweating through their shirts, they're being replaced by guys in glasses, typing on keyboards. And there's another innovation that's spreading like wildfire: portfolio insurance. It sounds safe, right? It's marketed as a way to protect your investments. If the market starts to fall, the computer automatically sells your stocks before you lose too much money. Think of it like a safety net. What could go wrong? As it turns out, everything. Early October 1987. Most investors are still riding high, but there are warning signs. Interest rates are climbing, the dollar is weakening, corporate raiders are everywhere. And then, on October 14th, just 5 days before Black Monday, something happens. Congress announces they're going to eliminate tax benefits for corporate takeovers. The market drops 95 points. Not catastrophic, but unsettling. October 16th, Friday. The market drops another 108 points, the biggest loss in history at that time. Now, here's where it gets interesting. Over that weekend, thousands of portfolio insurance programs are sitting on computers across America, and they're all programmed with the same basic instruction. If the market falls, sell everything. Nobody's working that weekend. The offices are dark. But those computers, they're watching, waiting, calculating. Monday morning is coming. October 19th, 1987, 9:30 a.m. The opening bell rings, and immediately the computers start to notice something. Prices are falling. Not much at first, just a little. But remember, these computers are programmed to react to any fall. So they do what they're programmed to do. They sell. But here's the nightmare scenario nobody predicted. When those computers sell, prices fall further. And when prices fall further, other computers see the drop and they start selling, which makes prices fall more, which triggers more computers to sell. It's a chain reaction, a technological avalanche, a death spiral. By 10 a.m., the Dow is down 200 points. Traders are confused. By 11 a.m., it's down 400 points. People are starting to panic. The New York Stock Exchange phone system is melting down. Every line is ringing. Everyone wants to sell. Everyone wants out. But here's the truly terrifying part. The computers don't care. They feel no fear. They don't doubt themselves. They just keep executing their programs. Sell, sell, sell. By noon, the specialists on the floor, the people whose job is to keep markets orderly, they're running out of money. They can't buy anymore. There are only sellers, an ocean of sellers, and the computers keep selling.
2 p.m. The Dow is down over 500 points. But it's not just New York. London, Tokyo, Hong Kong, Toronto, Sydney, markets around the world are collapsing. The panic is spreading at the speed of telecommunications, another gift of technology. Average Americans are watching this unfold on the evening news. They're calling their brokers, they're checking their retirement accounts, they're watching their futures disappear. Traders later said it felt like the end of the world. Some thought there must be a war. Others thought this was it, the next Great Depression. 3:30 p.m. Closing bell in 30 minutes. Behind the scenes, something unprecedented is being debated. Stock exchange officials are considering something they've never done before. Closing the market early, just shutting it all down. But they know, if they close the market in the middle of trading, it will send a message to the world: America's financial system has broken. The panic will get worse. They decide to stay open. Those last 30 minutes feel like 30 hours. Finally, 4 p.m., the closing bell rings. The Dow Jones Industrial Average has fallen 508 points, 22.6% in a single day. For perspective, that's worse than any single day in the Great Depression. The 1929 crash that triggered years of economic misery, that was a 12.8% drop. This was nearly double that. In today's dollars, over $1 trillion has evaporated, vanished, gone. But the day isn't over. As darkness falls on Manhattan, people are asking the same question. What happens tomorrow? Will there be a run on banks? Will the entire financial system collapse? Throughout the night, emergency meetings are happening. The Federal Reserve, the Treasury Department, the White House, the New York Stock Exchange. Alan Greenspan, the Federal Reserve Chairman, has a decision to make. He's only been in the job for 2 months. 2 months. And now this. October 20th, Tuesday morning. Will there be panic in the streets? Will there be a rush to withdraw money from banks? Will America wake up to find its economy in ruins? The market opens. And slowly, very slowly, the market starts to stabilize. In the weeks that follow, investigations begin. Congress wants answers. The public wants answers. And slowly, the truth comes out. The Brady Commission, tasked with investigating the crash, identifies the culprit: program trading and portfolio insurance. The computers. They confirm what happened. A technological feedback loop. Computers selling, which triggered more computers to sell, which triggered more computers to sell. A cascade failure. But here's what's fascinating. Within 2 years, the market completely recovered. By 1989, it was like Black Monday never happened. Everyone made their money back. So, no big deal, right? Wrong. Because here's what really happened after 1987. The financial industry
learned the wrong lesson. They didn't say, maybe we should slow down and think about this. They said, we need better computers, faster computers. Today, high-frequency trading firms use computers that can execute trades in microseconds. Not seconds, microseconds. Algorithmic trading now accounts for 60 to 75% of all US equity trading. The computers aren't just participating in the market anymore. They are the market. And we've seen the consequences. The flash crash of 2010, when the Dow dropped 1,000 points in minutes before recovering, caused by automated trading programs. Mini flash crashes that happen regularly now. They're not even news anymore. Experts warn that we're building a system too complex for any human to understand. A system where computers trade with other computers at speeds beyond human comprehension. After 1987, they installed circuit breakers, automatic pauses when the market falls too fast. But here's the question that keeps market watchers up at night. What happens when the computers get so fast that they can destroy everything before the circuit breakers even trigger?
October 19th, 1987 should have been a wake-up call. It should have been the moment we said, wait, let's think about this. Do we really want to hand over our entire financial system to machines we don't fully understand? But we didn't learn that lesson. Instead, we accelerated, we doubled down. And now, in 2025, your retirement fund, your savings, your financial future is being traded by algorithms you'll never see, following logic you'll never understand, moving at speeds you can't even imagine. The world is more connected now, more automated, more complex, and more fragile. The next crash won't be if, it's when. And it won't be triggered by fear or greed or panic. It'll be triggered by a glitch in a program written by someone who never imagined the consequences. In 1987, we got lucky. The system didn't completely collapse. The banks survived. The recovery came. But luck runs out. Right now, everything seems fine. The market is humming along, the computers are working perfectly, until they don't.
What do you think? Could it happen again? Let me know in the comments below. And if you want to understand the crashes that did happen after 1987, check out my video on the 2008 financial crisis. Thanks for watching. Subscribe for more deep dives into the moments that changed our world. See you in the next one.